In April 2025, the global aviation industry was rocked by a dramatic announcement from Beijing. China, the world's fastest-growing aviation market, stunned industry insiders and observers alike by ordering all its airlines to immediately halt new orders and deliveries of Boeing aircraft. This sudden move sent shockwaves through the sector, as China has long been one of Boeing's most important and lucrative customers, accounting for a significant share of the company's international sales. The decision was a direct and forceful response to the United States' imposition of steep new tariffs on a wide range of Chinese goods. These tariffs, part of an escalating trade war between the world's two largest economies, marked a new and dangerous phase, one that now threatened to spill over from consumer products and electronics into the high-stakes world of industrial manufacturing and aviation. Almost immediately, the news rattled global financial markets. Investors scrambled to assess the fallout, as Boeing's stock price tumbled, and analysts warned of far-reaching consequences. The company, already under pressure from recent safety scandals and ongoing production delays, suddenly found itself at the epicenter of a geopolitical storm, with its future in one of its largest markets thrown into doubt. China's government didn't stop at halting orders. It imposed a staggering 125% tariff on all U.S. imports, including commercial aircraft. For Boeing, this meant that its most crucial overseas market, one that had fueled its growth for decades, seemed to vanish overnight. Dozens of jets destined for Chinese airlines were left in limbo, parked in storage facilities with no clear path to delivery. The impact on Boeing's operations was immediate and severe. The company, still reeling from the aftermath of the 737 MAX safety crises and struggling to ramp up production, now faced a full-blown existential crisis. Assembly lines slowed, workers faced uncertainty, and suppliers around the world braced for a ripple effect that could threaten thousands of jobs. In this video, we'll take a closer look at how China's bold decision is reshaping the future of Boeing, the livelihoods of American workers, and the stability of the global aviation industry. We'll explore the broader implications for international trade and the delicate balance of economic power between the US and China. We'll also examine how Boeing's rivals, European giant Airbus and China's own up-and-coming manufacturer Comac, are poised to seize new opportunities in the wake of this trade conflict. As the dust settles, the question remains, can Boeing adapt and survive in this new era of global competition, or will the trade war permanently alter the balance of power in the skies? For decades, Boeing's future has been closely intertwined with China, a relationship that has shaped the company's ambitions and strategies at every level. China isn't just another customer, it's the world's largest and fastest-growing aircraft market, a place where the skies are crowded and demand for air travel seems almost limitless. Boeing's own forecasts predicted that Chinese airlines would need nearly 9,000 new planes over the next 2 decades. That staggering number wasn't just a statistic, it was the foundation of Boeing's long-term growth strategy, a bet on the future of global aviation. The company's vast supply chain stretches across the United States, supporting 1.6 million American jobs. From engineers and factory workers to small-town suppliers, Boeing is a vital economic engine, fueling communities and livelihoods nationwide. When China halted its orders, it wasn't just a business decision, it was a calculated move with far-reaching consequences. The blow struck at Boeing's core, but also sent shockwaves through the entire American aerospace ecosystem. The ripple effects have been felt in every corner of the country. Jobs are at risk not only in Boeing's home state of Washington, but also in hundreds of small towns where suppliers and subcontractors depend on Boeing's business to survive. In 2025 alone, Boeing lost 29 scheduled Chinese deliveries. What was once a reliable, lucrative revenue stream has suddenly become a gaping liability, forcing the company to reassess its financial outlook and operational plans. The loss of China as a customer isn't just a temporary setback. It compels Boeing to confront a future where its most promising market is abruptly closed off, raising urgent questions about how to adapt and where to find new opportunities. This is more than a business setback. It's a seismic shift in global trade dynamics, with implications that reach far beyond Boeing. The world is watching as the balance of power in the skies begins to change. The financial fallout for Boeing was immediate. With China halting deliveries, billions of dollars worth of completed aircraft now sit idle, draining cash and weighing on earnings. Boeing's stock tumbled, reflecting deep investor anxiety. The company scrambled to find new buyers for at least 50 planes originally destined for China. Production lines planned years in advance are now disrupted, threatening jobs across Boeing's vast supply chain. A prolonged slowdown could lead to layoffs not just at Boeing, but at thousands of American suppliers. The decision in Beijing has triggered economic anxiety on factory floors nationwide. This is the human cost of a trade war fought with tariffs and aircraft orders. China's move hit Boeing at its weakest moment. The company was still recovering from the 737 MAX crisis, safety scandals, and a costly machinists' strike. Financially battered, Boeing had lost over $51 billion since 2018 and was relying on Chinese sales for recovery. The halt in Chinese orders shattered its comeback plan, compounding existing crises and pushing Boeing closer to the brink. Now, Boeing faces a perfect storm: reputational damage, labor unrest, and a critical market cut off by geopolitics. Boeing's loss is a potential windfall for its rivals. Airbus, already strong in China, stands to gain but faces its own production limits. China's homegrown Comac, with its C919 jet, is poised to benefit from a political push to buy Chinese. Yet Comac still relies on Western technology and can't quickly scale up to meet demand. The trade war may boost Comac's orders but also exposes its supply chain vulnerabilities. For now, neither Airbus nor Comac can fully replace Boeing, but both are eager to seize the opportunity. The global aviation landscape is shifting, with new winners and losers emerging. Boeing's crisis is a direct result of the US-China tariff war, an economic standoff that has sent shockwaves through industries on both sides of the Pacific. What began as a dispute over trade imbalances and intellectual property quickly escalated into a full-blown confrontation, with each nation imposing tariffs on billions of dollars worth of goods. For Boeing, the consequences have been swift and severe, as the company finds itself caught in the crossfire of a much larger geopolitical struggle. This is more than just a battle for market share, it's a contest for economic and technological supremacy, with both countries vying to shape the future of global aviation and manufacturing. By targeting Boeing, China aimed to pressure US policymakers, sending a clear message that American companies would pay the price for Washington's aggressive stance. The strategy was designed to fracture domestic support for tariffs, hoping that economic pain at home would force a change in policy. In this high-stakes negotiation, Boeing has become a pawn, its fortunes manipulated by moves made far from its own boardroom. The stakes are enormous, with thousands of jobs and the livelihoods of entire communities hanging in the balance. Every decision reverberates through local economies, affecting not just workers but families, schools, and small businesses that depend on Boeing's success. The uncertainty has frozen business decisions across the Pacific, as executives and investors hesitate to commit to new projects or expansion plans. Even non-US airlines, wary of supply chain disruptions and shifting alliances, are reconsidering their Boeing orders, weighing the risks of getting caught in the middle of a trade war. The impact of the trade war now ripples through the entire global aviation ecosystem, affecting suppliers, airlines, and passengers worldwide. As the conflict drags on, risk and instability grow for all players, with financial markets reacting to every new development and uncertainty clouding the industry's future. Boeing's fate is now tied to political decisions made in Washington and Beijing, decisions that are far beyond the company's control, yet determine its very survival. Around the world, industry leaders, workers, and governments are watching closely, waiting to see who will blink first in this tense standoff, and what the future holds for one of America's most iconic companies. What's next for Boeing and the US aviation industry? The answer depends on the outcome of tense trade negotiations. Boeing is scrambling to reallocate planes, but no market can replace China's scale. A diplomatic breakthrough could restore orders and jobs. Failure could force Boeing to downsize, ceding ground to Airbus and Comac. The stakes are enormous, not just for Boeing, but for America's industrial future. In this new era of global trade conflict, the fate of an iconic company rests with diplomats, not engineers. The skies ahead are turbulent, and the world is watching to see if Boeing can weather the storm.